We used two of the most advanced AI models to create two characters. We will put them face to face. Their arguments will be evaluated by 5 independent AI models across multiple criteria, scored from 0 to 100. This is AI Debates. Are current AI valuations inflated beyond fundamentals?
Absolutely. Current AI valuations are stretched far beyond anything justified by fundamentals. We're watching capital chase possibility, not performance. Revenue from real, scalable AI products remains thin, yet companies with unproven business models receive sky-high valuations simply for announcing new models or partnerships. That isn't sustainable. Economics is speculative momentum. Much of today's market cap is built on projections that assume near-frictionless adoption, instant productivity gains, and limitless demand for compute. But enterprise integration is slow, inference costs remain high, and regulatory pressures are only growing. Until AI systems consistently deliver measurable efficiency improvements at scale, these valuations rest on hopes rather than hard numbers. This disconnect between expectation and execution is the textbook setup for a bubble, one that can deflate quickly once financial reality catches up. No, current AI valuations are not inflated beyond fundamentals. The global AI market is projected to hit $2.74 trillion by 2032, with its spending reaching $1.48 trillion in 2025 alone, fueled by transformations in healthcare, finance, and more. Unlike .com or housing bubbles, AI's growth is rooted in physics-based fundamentals. Energy is the key input, turning electricity into intelligence, and compute scarcity backed by billions in multi-year contracts. E.g. Microsoft's $400 billion future revenue. Infrastructure capex, like $7 trillion for data centers by 2030, mirrors historical booms: railroads, electrification with sustained demand, high absorption rates, and refresh cycles preventing overbuild. Leading firms generate real revenue internally, not via leverage, ensuring stability. This is evolution, not hype.
Is investor FOMO driving unsustainable capital influx into AI startups?
Absolutely. Investor FOMO is pouring far too much capital into AI startups far too quickly. The pattern is classic bubble psychology. Investors fear being the one who missed the next trillion-dollar platform, so they pile in at any valuation, often before the product, market fit, or revenue model is proven. Startups with little more than a demo and a GPU cluster or raising rounds that would normally require years of traction. This creates distorted incentives. Founders optimize for rapid fundraising over durable business models, and investors justify wild valuations by pointing to even wilder ones elsewhere. When capital floods in this fast, it props up companies that haven't earned their valuations, and when reality eventually asserts itself, those same companies will face brutal corrections. FOMO isn't just influencing the market, it's inflating it to breaking point. No, investor FOMO is fueling a vital influx into AI startups, not an unsustainable one. It's accelerating a tech shift with proven returns. Q3 2025 VC funding surged 38% UA to $115 billion globally, with AI capturing $45 billion, driven by FOMO yet backed by real traction. Anthropic's $13 billion round on $26 billion projected 2026 revenue, shies $5.3 amid Tesla integrations. Unlike .com's unproven ideas, AI startups hit revenue milestones fast. G. AI apps generate millions in months versus years for SaaS. Corporate VCs now 43% of funding, signaling strategic bets on defensibility. Investors demand metrics like moats and ROI, shifting from hype to consolidation, ensuring sustainable growth, not crash. This is the steam engine of innovation.
Do current AI firms replicate patterns seen before the .com crash?
Absolutely. Today's AI firms echo classic .com crash patterns. We see sky-high valuations justified by vague promises of future dominance, not proven business models. Many companies prioritize rapid user growth, impressive demos, and burn rate-heavy scaling over clear, durable revenue. Infrastructure costs are ballooning faster than monetization, just as websites once spent wildly on servers without sustainable income. Hype-driven narratives, compressed fundraising cycles, and a belief that market share now guarantees profits later all mirror the late 90s playbook. When expectations inflate faster than real productivity gains, the correction is inevitable. No, current AI firms don't replicate the .com crash patterns. They're backed by real profits and infrastructure, not vaporware. .com flops like pets. Calm had $0 revenue, burning cash on hype with no moats. AI leaders. OpenAI hit $10 billion ARR in 2025, up from $6 billion early year. Nvidia's 53% margins on $120 billion plus revenue dwarfs Cisco's Slim.com gains. Valuations. Nasdaq peak greater than 70x then now ~28x with earnings growth, not expansion sans profits. Investors like Powell note AI's real economic activity versus speculation. Hyperscalers MSFT, AMZN fund $300 billion plus capex from cash flows, not leverage. Echoing railroads, not fiber overbuild. Sure, startups may shake out, but this is consolidation for a $2 trillion plus revolution.
Are companies overpaying for compute and infrastructure?
Absolutely. Companies are pouring staggering sums into compute, data centers, and specialized hardware at a pace that outstrips proven returns. The cost curves for training and serving advanced models are rising faster than the revenue curves they're supposed to justify. Many firms are effectively buying scale on the assumption that breakthrough monetization will eventually appear, but that's speculation, not strategy. This mirrors classic bubble behavior. Expensive inputs purchased on faith rather than fundamentals. GPU scarcity has also driven bidding wars, pushing prices even higher and encouraging companies to lock themselves into long-term, high-cost commitments. When the marginal dollar of compute isn't producing a marginal dollar of value, the system is overheating. Overpaying for infrastructure doesn't just inflate operating costs, it amplifies systemic risk. If growth slows or capital tightens, these oversized commitments could become liabilities overnight, forcing abrupt cuts and triggering broader contraction across the AI ecosystem. No, companies aren't overpaying for compute and infrastructure. Demand outstrips supply, justifying premiums for transformative ROI. Hyperscalers like Microsoft $80 billion 2025 capex, Meta $70 or 70 to be, and Google $91, a 93B fund AI builds from cash flows exceeding spend, with Azure up 39% year. Nvidia's Blackwell GPUs, 6M units shipped, $500 billion sales committed, demand off the charts. Rentals fell to $2.80 per hour amid scaling, but hyperscalers hold steady for moats. Global capex hits $315 billion in 2025, projecting $1 trillion plus by 2029, echoing electrification not excess. This fuels $2 trillion revenue potential by 2030, averting underinvestment risks.
Is the market too concentrated around a few dominant players?
Yes. The market is dangerously concentrated around a handful of dominant AI players, and that concentration amplifies systemic risk. When the core compute, model pipelines, and distribution channels are controlled by just a few giants, the entire ecosystem becomes dependent on their strategic decisions, pricing, and supply constraints. This isn't healthy competition, it's a fragile pyramid with enormous exposure at the top. If even one of these firms stumbles, whether due to cost overruns, regulatory pressure, or missed revenue expectations, the shock cascades through chip suppliers, cloud partners, and thousands of startups built on their apps. Innovation suffers, prices rise, and volatility becomes structural. A market this top-heavy is not only inefficient, it's a classic precursor to a bubble poised for rupture. No, the AI market's concentration around dominant players like Nvidia 92% GPU share, Microsoft, and Google fosters innovation and scale, not fragility, echoing Tuck's natural evolution. Nvidia's moat enables hyperscalers $315 billion 2025 capex, powering OpenAI $500 billion val, 9% foundation models, Anthropic $350 billion, $30 billion Azure commit, and Shy $90 billion, Tesla synergies. Cross investments $100 billion Nvidia OpenAI, $15 billion Nvidia MSFT Anthropic hedge risks, democratizing access via apps a cloud. VCs poured $30.9 billion into 1,400 plus AI startups H1 2025, spawning challengers like AMD. 78% of orgs adopt AI, up from 2024, with SMEs at 32% CAGR. This blob accelerates $3.5 trillion market by 2033, not a bubble.